Brad, how has your day been so far?
It has been a notable day for me. So, should I do a brief conversation first, and we'll just go around and introduce everybody, or should I go into it now?
Let's start with a brief conversation, kind of come back into it, but give us like the 2 minute version of it at the
You
start. We'll
got
we'll
it.
give you a little bit extra time
Yeah,
here.
for sure. So, this last session, I guess, is the first time I think at least I can remember since I became that prototypical long term investor that I actually exited two long term positions in the span of one session. So I'm out of Boeing. I'm out of Teledoc Health. Shout out to Richard for being out of it before me and for faring better on that name than I did. But I'm happy to talk through kind of what I saw in that company in the first place that kind of enamored me, what changed so abruptly, and happy to talk through all of that with Teledoc and Boeing. But Facebook and PayPal also reported expectations were extremely low. Both results were a little bit better than I was expecting, and thesis kind of remains intact for both of those. But I'll leave it there for now, and excited to dig into things.
Sorry, was in there crafting the tweet. Still got one more second to get that out, but that'll be coming out in half a second. Love to hear that, Brad. Excited to hear a little bit more on a couple of the positions that are going. We know it was a rough week, but we saw that Facebook pop. I wasn't fully expecting it, but that definitely helped us out a little bit on that one. But a lot more to talk about going forward. Want to go around and bring each of our speakers into this a little bit, kind of just a little intro into you guys and how your weeks have been so far in the market. I want to throw it over to Richard next and throw that over to you.
Yeah, thanks for having me on. I think it's been definitely a tough year to date so far for growth stocks. Last time I think I was on this spaces like back in January, and I said that my top convictions were Carvana and GoodRX. And I think both of them have obviously been hit as well by the correction, particularly Carvana. So I'm happy to dive into those as well. And I haven't been following Teladoc as much, but happy to share like my take on their earnings as well.
Awesome. Excited to hear all of that. Jessica, how are you doing? Same question over to you.
Probably about the same as every long-term investor. This hasn't been the most fun quarter I've ever had, but I have a relatively high tolerance for volatility. So I'm just trying to concentrate on stocks that I think are a decent valuation for the long term.
I think this is a good place for us to start and get into it, Jessica. I would love to hear a little bit more about some of those stocks that you have been looking out for the long term. We'll get a little bit more into it. Actually, let me start here with the real purpose of this space, and then Jessica, I'm coming to you with that question. But more or less, there are so many spaces on Twitter for live trading and technical analysis and all this other short-term stuff, which is great. But the truth of it is the average person is an investor, a long-term investor. The average person in the market is a long-term investor. So we wanted to just make more spaces focused specifically on them. So on this space, we're going to be going through a bunch of different stuff, maybe some deep dives into stocks. It's earnings season, so maybe looking through some earnings reports and earnings reactions. The real purpose of this is to kind of educational, not really just taking, oh, here's what they said, but taking about how they're reacting to an earnings report or a thesis or anything like that they've been looking at, and seeing how you can kind of take the underlying thesis there and put it into your own game. We really want this, anywhere our speakers can throw in anything they're thinking extra educational for long-term investors. We would love to hear it. So with that out there, Jessica, I would love to throw it over to you. With that question, you kind of were talking about a couple of the stocks that you have been specifically looking at. I would love to kind of know what some of those are, and if there's any anything that makes you specifically excited about one or two of those.
Sure. I mean, there are a lot of stocks that I like long term, and probably most of them are pretty recognizable to people, which is one reason that I like them. To be honest, for me personally, when the market corrects, I kind of go back to my comfort level, which is big tech, and I get not just big tech, but stocks like Nike and Domino's, these high quality, very recognizable household names, the long-term compounders. That's my go-to when things are really uncertain, because the market has, I guess the market has already decided they're long-term winners, and who am I to argue? Because the unprofitable growth stocks, I genuinely don't know which of them are going to be a long-term success, but I am pretty confident that Domino's is never going to zero, at least not within the foreseeable future.
Interesting. So, like, how do you kind of deal with changing your portfolio or not changing your portfolio too much in the short term, kind of compared to stay in these long-term names? I could have definitely phrased this question a little bit more, but as the market has changed a lot, prices have come down for a lot of these stocks. How do you kind of keep your portfolio positioned in the right area? Is it that constant changing with the long-term perspective in mind, or is it kind of just like keeping your portfolio the same and kind of just pivoting at different points and kind of organizing at that time? I definitely could have asked that question a little better, Jessica, but I know an amazing answer is coming either way.
No, I think I know what you're getting at. I mean, look, I think this is our third 20% correction since 2018. So I've had plenty, anybody who's been investing for a few years has had plenty of opportunity to get used to volatility. So for me personally, I do buy and I do trade swing trade, buy and sell options. So people are always like, how do you have cash? I'm like, well, I always do. I like having cash, and I make sure to keep cash on hand for corrections, which, as I mentioned, and we've all figured out, are relatively frequent. So during corrections, and again, this is our third 20% in in like 4 or 5 years, I do concentrate on long term. The stocks that I'm buying are typically long term compounders. Does that make sense?
Yeah, no, it definitely does. So, awesome. Normally, I kind of come in with this and let the speakers come in and just kind of give their thoughts or whatever they want to talk about whether it's a deep dive or whether it's something different. I came in with a little bit of questions, trying something different on this one. But Jessica, I want to open it up a little bit more to you. Was there anything you kind of came here wanting to talk about? Was there any of your companies that recently reported earnings you kind of had anything you wanted to look into there? Was there anything top of mind you were thinking?
I was just, I've been watching consumer discretionary pretty closely, restaurants and retail, because honestly, that is one sector that, typically I don't go long, actually. I do like to swing trade that sector, and it gives you a lot of opportunities. These are highly liquid stocks that can trade as many shares a day as Amazon. But they don't move quite as quickly, which actually can be, it's easier when you're not constantly seeing your life flash before your eyes because your growth stock is down 20% for no reason. So I like consumer discretionary. They're also very well-known names. I can understand why people like Domino's pizza, so that's a big help as well. I don't need to be too I don't need too much specialized knowledge to understand pizza and donuts and burritos. But what struck me is, one thing is that the early reports are coming in really bad due to supply chain and inflation, the cost of commodities. These are some really high quality stocks are just, they're missing pretty badly. On the other hand, a stock I don't own, which is apparently a rock star, Chipotle, CMG. I mean, they, double beat that stock. I think a lot of people realize is a great company, but they really are. As more earnings reports come in, I am increasingly impressed with Chipotle the other day. So, you know, maybe not today, but that's a stock that I might have to put in my portfolio, especially if the market keeps coming down.
So I'm definitely going to ask this to each and every single one of our speakers because we are really in that time right now. How do you change up? You kind of mentioned it there a little bit at the end. We are in earnings season right now. We literally have Apple, Amazon, a bunch of others, Robinhood, Intel, so many going today. We had a crazy amount of earnings this week, leads to a lot more volatility. So kind of in this area, what do you kind of do with your portfolio around earnings? Is it kind of sitting back and letting stuff come out and really only making those big changes when they're needed, or is there any other kind of strategy that we have typically around these earnings? Jessica, did you hear that one? Sorry.
Oh, sorry. I didn't know that was for me specifically. I thought you were asking the panel. As I mentioned, do trade options, and I have been hurt. I I have been kicked in the teeth before. Anybody who trades options has made at least one really bad decision. So, as a general rule, I don't do anything around earnings. I don't even do lotto calls. Every once in a while, I think about it, and then I remember how badly I've been hurt in the past. So that's just me. I mean, I'm not selling AMD before earnings. You know what I mean? That's just not something I'm willing to do. But I'm probably not going to buy calls or puts or hedge, or I'm just going to let them do what they do.
Awesome. Appreciate all of that, Jessica. Before I do throw it over to Richard, I'm going to kind of actually use that one question there, talking about investing around earnings, whether it's before or even after a report. Do you wait kind of 2-3 days after? You do it right after? I do want to just come in and give a big shout out to all of our amazing speakers up here, Jessica, Richard, and Brad on this one. We have awesome co-host Wolf Financial. I'm the person behind the stock market news account that's up here as well. Big shout out to every single one of them. Make sure you're checking out and giving all of them a follow. But Richard, I want to throw that same question over to you with around earnings.
Yeah, I just wanted to say that, I try to not get into the habit of, I guess, selling after hours or trying to time earnings reactions. I want to invest in companies that I believe in for the long term, but mistakes do happen, and sometimes you get the long-term picture wrong. And so I think in those cases it does make sense to react quickly, and once you see that the original I guess drivers of your thesis are broken, then it makes sense to let go of that position quickly. But generally, I really don't want to be put in that position. And so, the companies I mostly invest in are earlier stage. So to get to Jessica's point, these companies, the future is a lot more uncertain than established wide moat companies. So, you're definitely going to have a few losers. So far, I don't think that any of my companies have necessarily broken my original thesis yet, despite the price action. Last time I came on, I mentioned that I would determine a company has broken my thesis if I guess I see some erosion of their moat, and what that means is if I see potentially competitors stealing market share, or kind of management leaving, some management turnover, kind of red flags like that. And I think specifically to give you an example with GoodRX, this recent quarter, during earnings, it really didn't seem clear what the cause of the deceleration was. But after earnings, I guess we had a talk with management, and we also got some takes from competitors as well. And as of right now, I think that they are sandbagging their guidance, because I don't think that competition has really had an impact. I think they're all suffering from kind of the same headwinds due to COVID, and so that's why I decided to keep the position. I could be wrong, but that's my take. And with Carvana, I think recently there's been a lot of talk about potential bankruptcy concerns. I think that with the ADESA acquisition, with the debt that they're taking on, it definitely puts them at heightened risk of bankruptcy. But really, I see this as I do see the unit economics getting better over time, and I do think that they will be profitable at scale. I think that in the near term, liquidity, I think the Garcias have been able to kind of put their money where where their mouth is, I guess, in terms of supporting the recent equity raise. And I believe there were rumors that they also put up a large chunk of money for the debt offering yesterday. And so, I think that's one part of it. Also, I think a point that bears miss is that with, their relationship with Ally, they Ally does support them in terms of constantly raising their floor plan and constantly raising their capacity to buy loans. So, rising defaults are a risk. Rising defaults on car loans are a risk, but I think the Ally relationship is stable, and so that removes a lot of short-term, I guess, expense related to their finance receivables as well as acquiring inventory. And so I think that their liquidity situation for the short term is fine unless we go into a large recession. So that's why I've been holding that position as well. And so I think if a company were to potentially show weakness where potentially competition encroaching, as was the case with Teledoc, where I think recently like the driver behind yesterday's miss was that they had to bring down kind of estimates for BetterHelp, which is their mental health offering, and that was really due to on the call they said I think competition really kind of rationing up their marketing spend, and that produced that resulted in higher CACs for Teledoc, so they had to spend more to acquire users for BetterHelp, as well as they mentioned like a lot of venture funding going to these smaller mental health startups, and that's kind of having an impact on them as well. And so I think that's like a red flag, honestly, because I don't really see BetterHelp as having much of a moat in the first place. So I think that is a red flag, and them removing their long-term guidance, or kind of saying that they're reevaluating their long-term guidance, is obviously not very good. And so I think with Teledoc it was a kind of a more serious situation. But happy to dive more into that if you guys want to talk about that.
I do definitely have a couple questions there, but as we're talking about Teledoc, I actually want to do this a little bit differently and bring Brad, and I think this is the perfect moment to give us a little bit on your Brad, your thoughts on what Richard was saying there in Teledoc in general.
Yeah, absolutely. I'm just gonna basically echo what he said and add some more context. So on February 22nd, this company reported its fourth quarter 2020 earnings, or 2021 earnings. So pretty much more than 90% of the way through their calendar first quarter that they just reported. And during the call, the bright spot was Mala Murthy, the CFO, and Jason Korovic both reiterating over and over again when they were asked by analysts, all of this BetterHelp competition that's coming in, the reports of higher churn and rising acquisition costs and heavier spend is not impacting BetterHelp because of their massive scale. They were, and I quote, immune to it. I'm going to read a quote from Jason Korovic because just to put in perspective how overly arrogant they were in hindsight. But having other virtual health, mental health vendors out there not performing at our level casts a negative shadow. To be honest, we simply outperform in this market. We are seeing all BetterHelp metrics make tremendous amount of progress across the board. That was on February 22nd. So in 8 calendar days, apparently, BetterHelp clicking on all cylinders, thriving, basically setting the company up for success for the long term, was now blamed for the exact same things that they were pounding their chests about being immune from: higher consumer acquisition cost, higher churn, lower LTV, all of these things that they were saying they were completely immune from pretty much the entire way through this first quarter that they just reported. They just blamed on the poor results. Just building off of that, the EBITDA margin that they put up was really not good, to put it bluntly. Their EBITDA guidance for 2022 implies about 300 basis points or 3% of EBITDA margin contraction. This is the margin line that the company tells us to fixate on because they spend so much on stock-based compensation, because there is so much amortization from all the M&A. So basically, we were told, don't worry about that. Focus on adjusted EBITDA, which I was happy to do in the short term. But now we're seeing that key performance indicator sharply invert lower. We also saw gross margin compression. We saw a massive $6 billion write-down from Livongo, which was kind of expected, but just poured salt in the wounds. And really, this was just a matter of completely losing trust in anything that management has to say about how the company is doing. I want to reiterate, we were told on February 22nd how immune the company was from the issues that it blamed for a poor Q1 2022 and a poor 2022. So just as a public market investor, I am deeply reliant on being able to trust the words that a leadership team is telling me. It is vital for me to believe what they're telling me, and I really disappointedly saying so. I can't make that assumption anymore. And considering how how much noise there's been around the Livongo integration in terms of chronic care growth, and I defended Teledoc for them and cited some cross-selling activity. But that made BetterHelp a much bigger part of the thesis, a much bigger part of the company's long-term future. And as Richard said, the moat here is extremely intangible. It's about branding. It's about scale. So that really is not all that defensible. And there were just very clear signs of what little moat they had here being torn down. So yeah, not a good quarter. I sold after hours yesterday, which I rarely do. And I think I said at the beginning of the call, first time in I think ever for me that I exited 2 positions in the same day. But just wanted to add also a little bit of color on GoodRX because I am a fan of that company, and wanted to add on top of what Richard was saying with the sandbag guidance. We were told on the call by Carson Vorman and Doug that they'd maybe gotten a little bit ahead of their skis, and they were kind of assuming that macro and elective care backlog unwind that they've been citing would actually begin to unwind in 2022. And not only did they take that out of their assumptions and their guidance, but they said, well, we're just now going to assume that it will keep growing the way it's growing. We're going to assume that the demand recoiling is going to get even stronger and it's not going to revert at all. Now, they also raised their prices on their subscription offering, which they had run some A/B split testing on and found very little churn as a result because of how much value these subscribers were getting. But they're assuming in their 2022 guidance that they get a heavy amount of churn and essentially flat subscriber growth this year. So just wanted to echo and reiterate that I think under promise and over deliver is an incredibly underappreciated talent and trait in public markets. Teledoc obviously didn't do that. But I think for GoodRX in that unique example, they kind of reset expectations to a point where I think there's now actually upside risk to their forecast rather than downside risk to the forecast. So they really did rip the Band-Aid off. And I used the opportunity to selfishly kind of build out my position because we're seeing things like market share grow for GoodRx. We're seeing things like take rate grow while they increase savings rates in their core business. And we're seeing them being held back by macro headwinds that are eventually going to abate. And when they do, I don't really see anybody else in the space that's more poised to take advantage than them. So two companies kind of in that digital healthcare space going in opposite directions in my mind. Yeah, I'll pass the mic now because that was a little bit of a lecture, but happy to talk about whatever and or Boeing or anything.
Yeah, I just wanted to add that, I agree on GoodRX. I think that management, like what really threw me off, I guess, was the fact that this recent quarter, they kind of tried to blame the slowdown on COVID, which doesn't make sense because, sort of last year in Q1, they had, a big slowdown in prescription growth due to COVID. So they blamed COVID in, I guess, Q1 2021. And now they're kind of blaming tough COVID comps for, the deceleration. So you can't have it both ways. So that, I guess, threw me off. But I guess after the quarter and trying to get a better understanding of, what exactly happened, I think that it basically came down to the fact that they were too optimistic in their guidance last year, where, they kind of baked in a recovery from COVID in the second half. And, obviously Omicron hit and they didn't anticipate that. And that had a pretty big effect on them. And this year, kind of, they're just assuming that the environment doesn't change. So it does feel like guidance right now is sandbagged. But I do think that, management didn't do a great job of setting expectations. However, I do think that their market share gains have continued and the competition isn't really having a big impact on them. So that's what makes me still hold to my long-term thesis.
Awesome. Love that back and forth. And honestly, if when any of you guys are speaking and anyone wants to respond to it after, just feel free to keep it rolling. I've definitely found in these spaces when we get that free-flowing conversation, it tends to be the best. And honestly, when we have a good, pleasant, nice disagreement as well, it honestly tends to even get better. So don't be afraid to come in that. Like I said earlier, the real point of this isn't, he's right, he's wrong, he's whatever. It's he or she, sorry. But it's more taking what these people are looking at and the type of information they're gathering and how they're looking at it and that type of stuff and kind of putting it into your own game, or at least learning the lesson behind what they are doing. Richard, I want to keep it on you though. I do have a couple other questions we can go into, but first, were there any other stocks? I know you talked about a little bit in the intro part, but were there any other stocks you have been watching recently, or comes to mind as big events specifically? And is there kind of anything that you've been looking at, or kind of that direction?
Yeah, I think, maybe a lot of people here own Roku, and I think that's another popular stock. Um, yeah, like I think Roku, they report tonight, and I think Roku has a great position in the US. Like I think, they have like 40% share or so of viewing time in the US. However, I think the two big challenges going forward, which will be important for, I guess, investors to watch, is Roku's ability to expand internationally and kind of increasing competition both from other, I guess, OSs like Amazon and Google, as well as, other kind of streaming players like Netflix, as they expand into ad video on demand, and I guess the impact that will have on Roku's economics. So I guess on the first point on competition, I think international will be a much harder challenge for Roku because I think Amazon and Google, like they have a willingness to kind of subsidize their unit economics. So what that means is, they're willing to pay, I guess, OEMs or the manufacturers around like $10 per TV just to get their OS in the TV. And Google, I think, is also willing to kind of do revenue share where they give the actual OEMs a share of the ad revenue. So obviously, Roku hasn't been willing to do that so far. And I think their market position in the US is strong enough to be able to handle that. So, with Amazon, Google being willing to, I guess, subsidize these TVs, then it might make it harder for Roku to expand there, as well as with Netflix and kind of the other big streaming kind of platforms like Disney Plus as well, expanding to ad video on demand. It'll be important to watch if they're able to capture, I guess, share from the long tail of apps. And when I say long tail, I mean like the smaller, streaming apps that aren't as big and they don't have the budget to be able to invest in the content to attract, viewers. And so, if this move allows Netflix and the others to take share, then that might make it tougher for Roku to kind of extract economics from these apps. So, typically Roku gets 20 to 30% share of ad inventory. And so that helps them to, I guess, monetize a lot from the smaller apps, but they have less leverage against, the bigger apps. With YouTube specifically, I guess it's been hard for Roku to really make any money from YouTube. And so I think with Netflix and Disney, even though Roku is a very important player, like I think they have a lot of market share and, they do have some power. It'll be important to watch, I guess, those dynamics between Netflix and I guess Roku.
That's very, very interesting. So Roku does go after the close today. 4:05 p.m. is what time it's expected to come out. We can go through a little bit more time to talk about some of the on an Apple, but probably is the third most cared about earnings coming up today. So, is that a name that you do own at all?
So I don't own it personally. But my employer does own it.
Gotcha. Awesome. So I do want to come at you with another question. It's actually a little bit of a different area on this one, but still in the theme. I want to ask you a little bit. Are you much more of a, at least to start out your investing, a top down or bottom up investor? So more or less for people or whatever. Do you kind of look at a more or less a sector or a thesis that you believe in, and then kind of work backwards and try and find a company? Or do you really find a company that you like and then work backwards and find the thesis and everything and make sure it checks out?
Yeah, so I'd say originally I was more of a top-down investor. So I would, I guess, find like a sector that I was interested in, like with Livongo, kind of that led me into health tech. And that led me also to, start research on GoodRX and others. And I think recently I've moved to more of a bottom-up investor where I really try to understand what business models have a higher chance of, I guess, building a sustainable moat. So you could look at, marketplaces. You could look at kind of vertically integrated, I guess, businesses like, Redfin or Carvana. And, these types of businesses, like they have a higher chance of, I guess, building a sustainable moat and kind of like more, having network effects to, or economies of scale shared to build like a winner take most or winner take all type dynamic. And I think and that's like what I really try to look for. It's really hard for early stage companies because it's you don't know if they'll be, I guess, overtaken by someone else. So I guess pace of execution and the ability of management are all really important to consider as well. But I think, like with my current portfolio, it's a few of the select stocks that I feel really comfortable with, that they have, these special advantages. And I think that they all fit into, I guess, like these kinds of business models. I think it's harder for top down because, like you can pick the right trend, and the trend might, help companies over the short term, like, a rising tide lifts all boats, right? But over a long term, it's like a competition is just going to come in, and the ability of a company to, I guess, capture value will, like their margins will inevitably compress as they kind of spend more money on marketing and research just to keep pace with, competition. And so I think like that's all important to consider, because when you're investing in a growth company, right, like most of the value is concentrated in the terminal value. So like that's like 5-10 years out in the future, most of that value is concentrated there. And if a company is eventually disrupted, then it's worth a lot less than a company which is able to grow at a slower pace, but grow for a longer period of time because they have, a moat that protects them from competition.
Awesome. That was all amazing. I want to touch on one piece on there. I do like to talk about it a lot. I think it tends to get overshadowed a little bit, but you kind of mentioned management there as one of the key aspects for kind of the long-term health of a company or the moat and everything like that. I wanted to kind of hear your thoughts around, how important looking at management and their team and their track record is for you when you're making an investment, and then also kind of double down on that question. If it is important for you, I would love to kind of, if you have any favorite under weird areas that you like to look at, whether it's LinkedIn, Glassdoor, or something even different. But yeah, I'd love to hear your thoughts there.
Yeah, so I think management is important, but it's not as important as the moat, right? Because I think, you can have a company with great management, with no moat. And what happens when that management team leaves, right? Like that company is just going to start heading downhill. So I think it's possible for great management to kind of build a great business in a very competitive industry. However, like the odds of betting on that are lower than a company which is more competitively positioned. So I think, like good management, of course, is needed to actually create that moat in the first place, right? Like you have the credit management to have the foresight to be able to make these investments. But I think, if we just compare management to moat, then like management is less important. But it's still very important to kind of actually realize that value, right? Like you can have like a great business, but you can have management that kind of isn't necessarily the best person to realize the value inherent in the company or its potential. So I do look at management, and I think some good areas to kind of look are Glassdoor, as you mentioned, and like watching like management interviews can give you a lot of sense of whether or not they have historically delivered on their promises. And so just going through past earnings calls, seeing like if they do like kind of set expectations properly and kind of I guess deliver on those expectations or exceed those expectations over time, and whether or not their original vision is actually kind of playing out, right? I think like you can look at like the Trade Desk and Jeff Green, and for the longest time he's talked about how Netflix will eventually be forced to take on ads, and obviously that has played out just his expectations. And he thinks that eventually the walled gardens with Facebook and Google will have to come down as well. So that remains to be seen. But so far I think he's definitely delivered on the vision of Trade Desk, and he's time and time again explained why I guess demand side platforms are better positioned than supply side platforms, and that I think has certainly played out so far.
Awesome. Thank you. And then just one last question on this management topic, and I'm actually going to bring Brad back into it. How do you kind of deal with, like, how big is your rope, more or less, we'll say on this? Is it 2 strikes you're out, 3 strikes you're out, kind of, or is it really just kind of the long term of how the company's doing? How do you kind of take about, more or less what I'm asking is that continued trust with management? Is there something kind of specific into it, or is it really just like how bad they missed, or kind of a case by case?
Yeah, so I think it really depends on their ability to, I guess, be honest with investors and really set expectations. I guess if management tries to hide something, or if they, I guess, don't seem to have a great handle on the business, or when things go wrong, if they don't have a great handle on how to fix it and what exactly went wrong, then that really hits your confidence, right? Because as an investor, I mean, you can have your opinion of how a company is advantaged, but if management doesn't really like understand that, or if they don't have, I guess, the same kind of foresight to be able to realize that, then it's just a theory, right? So I think it's important to watch their execution, and great management teams, like over time, like there's a difference, right, between great management and average management. It's relatively easy to tell bad management from the good ones, because there's going to be a lot of red flags there. But I think it's much harder to be able to tell great management from average management, especially like when you're earlier on and you don't have that track record. So it's really important to watch like their execution over time, and yeah, like I think that's really the key to it.
Awesome. Thank you, Richard. I just checked in. You're at 69.8 thousand followers. I was about to come in and say, make sure everyone goes in and checks out your page, but we don't want to knock you above that legendary 69K followers number. So a big shout out to that. If you enjoy anything Richard just said there, clearly a very, very smart guy. Definitely go in and check out his profile and give him that follow button. Awesome. Appreciate you coming on these spaces, Richard. We actually might come around for another question or two around to the entire panel. So feel free to stick around. But I want to take this time to throw it over to Brad now and hear if there was anything specific that you wanted to kind of touch on at the start before we came into any questions.
Could you remind me what the question was for me to answer?
Honestly, just what you're thinking. How has it been this week? Any of the stocks standing out? What kind of have you been doing? How are we feeling in general? The part you saw really is top of mind, honestly.
Sure. I mean, there's been news today about Joe Biden and I'm not getting political, so don't think I am. I'm about as center of the aisle as they come, but getting or considering student loan debt forgiveness, which I own SoFi, and that's their largest and most profitable segment by a pretty wide margin. So that, I mean, they've already assumed that student loans would be kind of turned off until the end of 2022. But a forgiveness would just lead to more turbulence there. And I mean, this is a 50% volume hit to this segment for as long as it lasts. And obviously forgiveness would not help there. I will say that would be a pretty radical move, and it would piss off a lot of people heading into November and moderate voters into a midterm election season. And I think it would be to gain some goodwill with voters, but I don't think it would accomplish that. But I'm not a political strategist, so I could always be completely wrong there. But I mean, that's just to say, at the end of the day, student loans will be an industry over the long term, and SoFi will continue to fetch the dominant market share position that it has. And I mean, in the meantime, we're just seeing a company really still overcoming and performing extremely well. I mean, I'm gonna pull up the forward multiples really quickly, but I know off the top of my head, it's still doing north of 40% growth this year to get to nearly 1.5 billion without its largest segment having access to about half of its volume. So and also, I mean, EBITDA is supposed to triple this year and triple again next year. So they're still doing everything that they need to be doing. That's in their control, but this exogenous headwind has certainly been annoying, and it looks like it's going to continue. For me, I know this might sound frustrating or insensitive to some other people, but for me, that just gives me more time to collect disposable income and to be able to accumulate more shares. But I don't really I don't really see this student loan noise kind of, and that for me specifically is certainly relevant for SoFi. The other two earnings reports I had yesterday, which neither of them were that great, but this just goes to show how important, I guess, expectations coming into the reports are. But Facebook was a little bit better than expected. I heard Zuck, and then maybe I was just wanting to hear this, but as more optimistic with kind of overcoming these IDFA and Apple headwinds than he's ever really been in the past. They've now addressed most of the reporting gap or underreporting gap that they've had in light of this kind of signaling headwind, and they guided to accelerating growth in the second half of the year as things like e-commerce growth normalizes post-pandemic, as Reels monetization ramps, which I'm very confident it's going to do, and which they're very confident it's going to do, and they're not often optimistic. So when they're confident, I take that more seriously than I do with most other companies. But in user growth, daily active user growth for Facebook alone, not just talking about the family of apps, still grew about 1% ahead of expectations. Wasn't really expecting that, especially because Russia banned Facebook and they lost a few million users there, or more than a few million. But yeah, I mean, I think a lot of this TikTok is going to be the end of Facebook, and the metaverse spend is going to be the end of Facebook, is really being amplified by very tough industry-wide e-commerce growth comps in relation to the pandemic that we're now measuring versus when e-commerce adoption was pulled forward by 3 to 5 years, depending on who you want to talk to. It's compounded by this simultaneously happening with this content shift to Reels, which is going to take some time to ramp in terms of monetization. But I mean, as confident as I can be with things that haven't come to fruition yet, coming to fruition. I think Reels monetization ramping and e-commerce strengthening as comps normalize are pretty safe bets. And when that happens, those are going to be two really lucrative tailwinds for this company to kind of combat this margin compression and make things like heavy metaverse spend and heavy AI spend to build out their ad stack a little bit more compelling and a little bit more palatable. And I really do see that playing out over the course of the year. And I think PayPal is in a very similar situation in terms of suffering from e-commerce growth, suffering from this eBay operating agreement ending, just weighing on growth. 8% hit to their growth this quarter, and they took down guidance actually for 2022. But similarly to GoodRX, it was a matter of them being way too overly optimistic about e-commerce trends kind of being maintained through the end of the pandemic, and shifting from that to kind of being as pessimistic as they possibly could be. So not a perfect quarter by any stretch of the imagination for PayPal, but we also saw things like them continuing to take real market share in BNPL from a lot of these other players that could struggle with tightening macro, while PayPal's a little bit more insulated. And we saw them take e-commerce payment market share in their core markets. So that to me is just evidence that this is macro-induced, that this is exogenous headwinds that are weighing on the business. And we got very similar commentary from Google and from Facebook and from all these large players that make me more confident that this isn't a matter of PayPal's value proposition or what they're offering to customers. It's really just a matter of their world being a lot tougher than it has been over the last 24 months, and them extrapolating a really easy macro environment to be more permanent than it's turning out to be. So I selfishly kind of used that getting ahead of their skis in the middle of last year to start the PayPal position around $140 a share. And since then, I've just been pretty aggressively adding all the way down to, I think we're where we are now, 80 something. But yeah, those, I mean, you heard me kind of rip into Teledoc. I'm very comfortable with turning on my holdings and preach no loyalty, which I tweeted today, to any of our companies. But for Facebook and PayPal, there was nothing super concerning or alarming to me that would force me to kind of abruptly change my mind about the company, like there was with Teledoc. So that's really all I have. There was a cool CrowdStrike public market case study from the Illinois State Treasurer that came out earlier this week that was pretty encouraging, but not a lot of information to share. And that's all I got. But happy to talk about things a little further and deeper if you'd like.
I'd love to, before we go anywhere else, I'd love to hear your thoughts on the bottom up or top down, investing style. When you are looking for these plays, is it really that company first that you find and then dig into the sector and become an expert of it? Or is it really that other way around where you find that sector and you're like, what part of it do you want to kind of go through? I was going to say exploit, that gives a negative connotation, but you know where I was going to invest in and, take to your upside.
Yeah, I'm extremely micro focused when it comes to picking positions and starting positions. I do use macroeconomic indicators a lot more heavily for building positions and for accumulating and trimming. But in terms of stock picking, it's very much so bottom up. And I mean, I own a company like Revolve where, okay, look at their business model. They're an online fashion retailer, so that there's really nothing special about what they're doing in terms of the business model. And yet The management team has just performed so admirably over the last, and obviously I'm a biased cheerleader of the company, but they've overcome a lot of very difficult headwinds that they've had to deal with in terms of supply chains and fulfillment and freight. And they've done so while expanding margins and all these wonderful things. And they've done so while printing cash, as opposed to the Etsy's of the world and the Reels of the world that are not printing cash while they grow. So I love taking it company by company. I think within that example that I gave, there are fantastic investments within e-commerce retail, and there are terrible investments within e-commerce retail. And I think that's pretty true across all industries, no matter where you look. So, I probably just leave it there.
Awesome. Thank you, Brad. Do we have any of your other companies reporting earnings this week, or is it really kind of that's it? We're into next week. I remember last earnings season, you had a bunch of your earnings coming really late, so I'm kind of assuming that's what's going to be happening here, right?
Yeah, I mean, my first 4 earnings reports were really the 4 problem children in my portfolio. So next week, I'm just pulling up the list really quickly. I've got Revolve Group, which they've done. I mean, earnings reports are usually a victory lap for them. Match Group, Green Thumb, which is one of my cannabis companies, and then Penn National Gaming are all reporting for me next week. So another busy week. Excited to have gotten through PayPal and Facebook, which if you're an investor in either of those companies, you know we've been dreading this quarter for a long time, and then there were a lot of headwinds that they've had to deal with, and we got through it. So if you're wondering why did Facebook and PayPal guide down and their stocks are reacting positively, it's because just expectations and sentiment got so overwhelmingly negative. I'm not commenting on how that's going to kind of manifest itself in the stock moves over the next several weeks, but just today, that's probably the reason. Just excited to have gotten through these quarters, and now we can move on to kind of brighter days for PayPal and Facebook, in my opinion, that are going to come to fruition. But Revolve Group and Match and Green Thumb and Penn National Gaming next week. So excited to dig into all of those and report back.
Awesome. Excited to hear all of that. All right. So that is pretty much all of us going through. I want to give us plenty of time to go through on the wrap-ups. Pretty much just as a part of this, I would love to hear any extra thoughts, maybe any lessons or whatever you got specifically for long-term investors. You learn new stuff in this space, in every space, every single day. So we'll love to hear anything that is top of mind for you guys there. And then just kind of on top of that, we'd love to hear more of what you all are doing, where we can find this extra content, if there is any other places, newsletter, YouTube, whatever it is, and just kind of anything along that lane. I'd love to throw it over and start with you, Jessica. That's cool.
Sure. I think we all know anybody who is a new investor or started investing in 2020, I think they figured out by now that growth stocks are volatile. And I guess I just want to give a shout out for the boring stocks that nobody cares about. There are probably a lot of great stocks right now that are down 80%, but some of them aren't coming back. And some of them really might go to zero. But Domino's, Chipotle, Adobe, Apple, Google, those stocks, they could theoretically go to zero at some point in the future, but it's not happening anytime soon. In a correction, you're probably not going to go broke buying Nike, but you really might go broke buying unprofitable growth stocks. So please be careful and do your research, especially if you're buying a falling knife. It's dangerous to think you're smarter than the market.
I very, very much agree with it. And I think that, it's super, super hard to pick these individual stocks. These people are really when you're shooting for that 10X, you're really hitting a 15%, 20% batting average, and you're killing it in this space. And I think what really goes back into it is the tons of hours of information gathering, knowing and understanding the market, the companies, the industry, the sector. And even at that point, you're still probably going to get most of them wrong. It is super hard. I personally am not smart enough to be in that area / put enough time into it. So I like to play it through ETFs, but I very, very, very wholeheartedly agree with that sentiment there. Jessica, or do you have any other places that you're making content, or is it really just through the Twitter?
Primarily through the Twitter. I have been doing a podcast recently, but you'll find the links on Twitter.
Awesome. Link in the bio, though?
It's not the pinned tweet, but anytime I do a podcast, I will share it. So it's findable.
Awesome. Well, make sure you're following Jessica to get that podcast and all amazing insights and information coming at you. Huge shout out to you, Jessica. Definitely going to have you back on one of these long-term investing spaces. Loved having you on. Awesome. Going to keep us moving and throw the same question over to Richard. Any extra things you want to leave with long-term investors? Any other thoughts? And then, where we can get some more of the stuff that you are doing.
Yeah, I mean, I just wanted to say that, like the past 2 years have been extraordinary, not just in terms of, I guess, the stock market, but I guess, the world. And I guess the stock market volatility has been kind of a reflection of that. So obviously in 2020 and early 2021, just every stock was going up like hundreds of percent. And it was like a great time to be a growth investor. And like after, I guess, February 2021, and especially with like the past 6 months, everything has just been going down. And I'd say like the correlation between like these growth stocks has been kind of something that is not usual, or like it's like it has rarely happened to this extent in the past. And so, I think a lot of growth investors might be questioning, I guess, their philosophy or their process. But I think, it is important to note that these 2 years have been kind of very wild. And, even company management, like you look at, for example, Peloton or Carvana, GoodRX, like they have, like their management have also had very low visibility into, like, I guess, trends, like just like a few quarters out. So just given, COVID and now supply chain issues and the war in Ukraine as well. And these are just crazy times. And I think that's important to reflect that it might not be like your process that is wrong. It might just be, like kind of like getting unlucky, right? Or it's like there's some things that you just can't predict. So I do think it's important to manage risk, and I do think it's important to learn from your mistakes. But I would also say, just to, I guess, keep your chin up and not, I guess, be like feel like too discouraged just because of, I guess, the short-term results.
Awesome. Thank you so much, Richard. Love having you on these spaces. You have a newsletter that you write, or I know there's at least a couple other stuff you do. Newsletter, right?
Yeah, like if you want to, check my stuff out, then you can see my bio, and I think there's some links in there.
Awesome. Well, big shout out to you, Richard. Make sure everyone is going in and checking out his profile. You definitely heard why he was a very, very smart guy and is an awesome follow to have. I'm going to throw the same thing over to you now, Brad. Wrap ups, anything extra you want to leave with long-term investors, and yeah, where can we find some more of the stuff that you do?
Yeah, I think just really important for me to balance two ideas. One to just be wholeheartedly focusing on company performance and forward expectations and all signs pointing to strong and sustainable and brisk revenue and cash flow compounding, and use those indicators to know what positions I want to own, what companies I want to have in the portfolio. But then again, using all of this macroeconomic uncertainty that Jess and Richard elegantly talked about, and respecting all the uncertainty and fear in markets, and understanding that Mr. Market hates fear and hates uncertainty. And while something let's call it GoodRX trading well below now a 1x PEG ratio looks really compelling and has a solid base of net income and free cash flow to be valuing something off of, things can always get more irrational, especially in times where we're raising rates, where we have a CPI print setting decade highs. It's going to come down. No one knows how quickly it's going to come down, and rates are going to go up in the meantime. Balance sheet runoff is going to happen in the meantime. Supply chains are going to continue to painfully work themselves out and take time to do so. In the meantime, there's going to continue to be geopolitical tension in Russia. Who knows what's going to happen in China and Taiwan and what's happening there. There's just so much to consider, and that kind of the effect of that idea is that I still am always predominantly invested, but especially right now, I'm clinging with two hands to that elevated cash position. It's gone It's gone from kind of like 20-ish% down to 7 or 8% over the last several months. I've gotten that back up to about, I don't want to give a wrong number. It's somewhere around 14%. I could be off by 10 or 20 basis points. But as I've been telling people, there's another 5% infusion coming from my account. So I am using that cash to feel calm, to feel nimble, to feel flexible during these very panicky times, so that when there are these thriving companies that I'm wholeheartedly focusing on fundamental performance and not their charts, I have the capacity and I have the ability to take advantage of these deals that I kind of perceive to be irrational. And because I want to have that optionality and that flexibility, I have to add at a very slow pace. I have to be either adding at the same pace that I'm adding cash to the account, or adding at a very slow pace. So that's really how I've done things and how I will continue to handle this correction. Right now kind of sucks, but these periods of immense turbulence and immense volatility within growth stock land have been really great time periods to stick to that Warren Buffett mantra of be greedy when others are fearful. So I will be doing that in an extremely cautious manner, and that's just going to be the plan going forward. Really enjoy listening to Richard and Jess as always. I think we'll talk on Friday probably in other spaces, but if I don't talk to you guys again, have a great weekend. Go outside, enjoy the weather, play some golf, watch a baseball game, do whatever it is that you do to kind of relax and decompress. Because right now, I mean, if you are emotionally coping with these massive sell-offs and this massive volatility that we're dealing with, if you're a long-term investor coping with it and enduring it, then you should be patting yourselves on the back and not really stressing out and worrying about this on Saturday afternoon. If you want to do some research on a company, perfect, but kind of give yourself a mental break. I think that's extremely important. And I'll just leave it there. Tough times, but I firmly believe brighter days ahead. And yeah, have a great weekend, everybody.
Definitely love all of that, Brad. If you want to feel a little better, also go in and check out PayPal right now. It's moving in a good direction for us PayPal owners right now, up 10%. But we just got this whole space is done talking about long-term investing. We're not going to come in here at the end and just talk about some short-term price movement with PayPal moving higher. But huge shout out to Brad as well. Make sure you're following every single one of our speakers up here. Brad, what about the newsletter we got going, the free weekly newsletter that goes out on Saturdays? We doing that again this week?
Yeah, comes out every Saturday. There's a single click subscription in my Twitter bio. And yeah, a lot of interesting stuff to cover. So thanks for letting me talk about it.
Awesome. Yeah, everyone go in and check out the link in Brad's bio. Shout out to Jack down in the crowd. I saw your requests. We are in the wrap-ups. Definitely will have to get you back on one of these long-term investing spaces in the near future. Love having you on all these spaces. Really smart guy down there, Jack, if you want to check him out. But I want to throw this over to Wolf as well, my amazing co-host. We didn't hear much from you on my spaces. Always love hearing from Mr. Wolf up here. I want to give a quick shout out. Our next spaces that we'll be doing together is on technical analysis, featuring Alpha Trends, Brian Shannon, and then Richard Moglin. Awesome spaces each and every week. We're going to be doing that right into a live earnings covering Apple, Amazon, Intel, Robinhood, so many more. So we're going to be a full day of spaces. If you want to tune into any of that, click the link above pinned in the nest, and that will set a reminder for you and give you a notification when we go live. So one more time, just check out the pinned tweet above in the nest. And Wolf, I want to get you if you have any comments or thoughts here.
Hey, man. Yeah, no worries. I definitely talk a lot these days, so it's always great to be able to sit back and kind of listen to you and some of the others talk shop on here. In addition with that, you are 100% correct. We have some incredible spaces coming up today. We have the 3 p.m., we have the 4 p.m. with the earnings, doing a 5 p.m. and a 6 p.m. after, and then a NFL draft party space, which Brad, you should hop on. Brad, you free tonight? NFL draft party Twitter space?
TBD.
Okay. We'll see what happens there. But yeah, a lot going on. Just want to, give a lot of praise right now to the speakers that came on here, Richard, Jessica, Brad. It's tough in this environment to come out and, lay your case for the stock and say, even, these stocks are down to these points. Here is my fundamentals and what I'm sticking by. So major props to them. Great follows as well, if anyone hasn't already. And of course, Stock Market News, the guy behind the Bullish Rippers account on this space, is a fantastic follow. And I also do spaces as well from the Bullish Rippers account. For anyone that hasn't already checked it out, if you're following myself or Stock Market News, the Bullish Rippers account is a great account to be checking out. We both do content from there, mostly Stock Market News. I do a couple spaces a week. Did a fun space yesterday on the cybersecurity industry We did a great one on Monday, right when Elon buying Twitter news was announced. That was a huge space. We had an awesome time. So yeah, just great to come here and listen to these long-term ideas. I still have my long-term portfolio, certainly making less moves than I used to on a daily basis in a market like this. So this is definitely a valuable space to be attending, and I hope everyone will come and tune into our one at 3 p.m.
Awesome. Yeah, that Elon space on Monday, we literally went live the second it was announced, and that was definitely the biggest ripper space that we've had so far. We've had one or two larger ones through the Wolf account and through my own, but we had like 9,000 people tune in live. Was pretty great. I think we got over like 1,700 people. But doing a bunch of awesome stuff from this Rippers account, really trying to put out some good content. Specifically around earnings, it becomes a little bit easier. I got a bunch of stuff to post from this account. So huge shout out to Rippers. We're doing some really cool things here, like getting all these really, really amazing speakers to come on and give you all some free, we're going to say some free alpha, but some free information and some really expert thoughts of people who are in this business, in this industry, kind of doing the same things we all are and really kind of putting the time and effort and work behind it. So I love having these people on. One more time, make sure you go into all of their profiles, check them out, and give all of them a follow. All awesome accounts. You really can't hide on these spaces. These are live. There's nothing pre-planned, no questions being sent before. So who knows what they're talking about and who doesn't when they come on these live spaces. And, the real truth of it is you don't enjoy someone's content, you can hit that unfollow button. You're not going to want to, but I would heavily advise just going through and hitting the follow button on all these people and going back through it later. Very, very smart people who will definitely have back on this long-term investing spaces in the near future. All right, I'm going to quit the rambling here. I'm going to give us 10-15 seconds to let the delay catch up with the crowd. Also, after that stutter, maybe I shouldn't. But yeah, one more time, thank you for everyone coming on, and we'll see you on the next space.